Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. I'm so excited about this episode. I've got Jeannine LiChong of Waratah. Everybody knows her on Bay Street. She came up under Ira Gluskin at Gluskin Chef, and now she's running money at Waratah. And she is just very smart. And we need that on a day like today. In the last 24 hours, we have been whipsawed around, but markets are still under significant pressure. And people are asking, is this a crisis like 2008, like COVID? And what should I be doing with my money? Jeannine offers a great perspective on what she's buying and, importantly, what she's staying away from. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and the guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO Investor Line. If you're an experienced trader, BMO Active Trader is the platform for you. With advanced tools and capabilities like multi-leg options, screeners, and strategy builders with margin trades, you'll have everything you need to take your trading to the next level, giving you the edge you need in today's markets. Learn more at bmo.com/advanced trading. Jeannine LiChong of Waratah, thank you so much for joining me.
Thanks for having me, Amber.
I have been trying to interview you for a very long time, and I'm sort of annoyed that you're coming in now when the markets are just so chaotic, because I just have to jump right into the market action. Is that fine with you?
Totally.
Okay, where do I begin? We are seeing one of the worst routes that we've seen maybe since the financial crisis, 3-day route. We walked into the day, there was red on our screen. There was this false headline that maybe the U.S. was close to a deal, and the markets rallied, I think it was 7% in 34 minutes. It seems like that headline is fake, and now markets are selling off. This just took place in the last hour. You're trying to run money for the long term. What are you doing right now?
Okay, I have to say, we set this interview up months ago, so I didn't even know this was going to be on the day. However, it is on the day. And the market action that you talked about happened on my way to here. So actually, you had to tell me what was happening to the market. I was away from my screen. Thankfully, we're long-term investors, or my style has always been to be a long-term investor. There is going to be a lot of noise as, Trump has taken office. So we expect that. And it's very difficult, but you have to sort of take a longer term view is my advice and my approach anyway to investing.
I feel like that's easier said than done. I mean, just to speak to the fact that you were like, when you came in, you didn't know. I was doing my makeup and my producers running around saying, the Dow is now up, the Dow is now up. So that's kind of how chaotic things have become. And when you say it's, you just got to be long-term oriented, it feels like everything we've known about the foundation of the global economy is changing with these tariffs. What have the discussions been like in your office? Like, how do you hold true to the stocks that you own? Do you think there's a big, massive structural change afoot?
So we have different funds in our office, so I would say there's different approaches, and there are people who are more short-term trading and they're very good at it. I would say I am not. I'm more of a long-term trader. I have, maybe for better or worse, been investing, been in this business for a long time. So I actually was around when 2008, I was managing money in 2008 and had to deal with clients. And obviously, COVID hit, which was existential, never seen before. So this is quite different, I would say. And what's difficult for investing, as it was in the 2008 crisis, is that the rules keep changing. And you never know from day one when you wake up in the morning. If you recall, there was a short ban. There were different rules in terms of regulation for banks, and nobody knew what to do. And I think we're in a very similar situation where the goalposts and the rules keep changing. It's hard to invest, I agree. So what we do is we basically watch. We don't try to anticipate. I think it's very difficult to anticipate because if you position a portfolio one way and the rules change, just like you said, it was a fake headline, you're going to get whipped. So we would prefer to be a little bit patient, a little conservative. We are conservative. We're going to get into the portfolio positioning, I'm sure, later, and then see how the rules and shake out. But I don't disagree with you. There are going to be massive changes in terms of structural supply, trade flow that could have a significant impacts on certain parts of the businesses and certain industries.
So then what does that look like in the portfolio? We are going to get into specifics. Like, what does that weighting approach mean? Do you put on short positions, or are you even cautious on that, preferring to sit in cash?
We have more cash than we do, I would say, than short positions. Weighting means being in companies that you know that will weather the storm, and probably at this point have less economic sensitivity, just because we don't know what's going to happen. It doesn't mean that we don't like these companies. It's just that we're waiting to see how it happens, because the short-term results could be so impacted quite significantly. On the other hand, if these companies actually get impacted, it might be a good buying opportunity, as we saw in 2008 and 2020. I think it's a little early now, personally, just because of all these headlines, and nobody knows what the final rules are. So at this time, and I know it's a funny time to do this podcast, I'm being patient right now. I'm not really deploying a lot of capital.
So you mentioned, your long history in the markets. 2008, were you at Gluskin at that time? Gluskin Sheff.
Yeah.
So very famous and successful independent fund before you left, and you went straight to Waratah, where you are now.
Correct.
Okay, so let's go back to 2008. As you said, it's wild, it's chaos. Rules are constantly changing. There is that temptation now. We've been through a couple of these cycles to come in and buy the dip. What is it like? What did it feel like? Did you have a sense of March 9th, 2009, that was the bottom? And how do you have like a checklist of things that you look at to say, okay, maybe we are closer to the bottom?
So I would say 2008 feels very different from even 2020 and today, in the sense that 2008 to me was actually scarier, because you thought the whole financial system was going to crater. You didn't know what book value was. It was very, you didn't know if it was going to survive, and eventually it did. Liquidity was pumped in, it was survived. This time it's just trade. 2020 was COVID. Nobody knew how long that was going to happen. And you had businesses that actually revenues went to zero virtually overnight. That's very scary, but the system wasn't broken. I would say businesses right now, they're not broken. They just have to adjust to the new tariff situation. And the problem is we don't know what the new rules are. We don't know what the tariffs are. So until we get clarity on that, and businesses will adjust. I am very confident in the resilience of businesses and the creativity that they get through. But they need a transition period. And first of all, we don't know the rules. Secondly, we have to go through a transition period. And thirdly, we have to see how each company actually adapts to the new situation. It's similar to interest rates rising, right? Everybody knew that the interest rates were going to rise. Maybe we were a little surprised about the magnitude and the speed of it, but companies had to adjust. And once they can adjust, and inflate. We had inflation at the same time. Once they adjust, the companies, actually put it into their business model. But we're not there yet, in my opinion.
Okay, so you want to see a little bit more policy certainty and clarity. And even if the tariffs remain, there are places that are going to be good to invest.
Correct. There's always opportunities in these kinds of dislocations, and it's our job to find those opportunities.
I wonder how you think about global exposure. Are you staying in Canada? Do you want companies that have maybe more domestic focus, or would you prefer, companies that are exposed to, the winning theme has been exposure to USA all the way?
Right. So I run mostly Canadian equity portfolio, so I'm kind of biased that way, but we do have the ability to invest in U.S. securities, and also a lot of Canadian companies, as you know, do businesses in the U.S. And you're right, the U.S. has been the way to go because it's been the growth engine for the global economy. So it's been a good place to be. I have confidence that the U.S. will actually be also in, as we get through this, they still will be the growth engine. They have good productivity. There's a lot of entrepreneurship. They have a, open capital market system that allows it, that encourages that. Right now, I would say We do have a bias for Canada at the moment, only because we don't know how the tariffs. So what I would say, let me qualify that a little bit. We have a preference for companies that actually have less exposure to tariff risk right now until we get clarity on the policies.
Do you think that there's going to be a recession in the U.S.?
I think there's a good chance we could have a recession, but there's definitely going to be slowdown in growth, both in Canada and the US. And I think people thought that even prior to the tariffs.
Because everybody's baking in fully a recession in Canada. So it's interesting that you kind of have that preference for some Canadian securities. I imagine you have to be so nimble and make sure they're not affected by tariffs and they're not affected by a recession.
Yes. But I actually think these tariffs could be an opportunity for Canada. We obviously are coming up to a federal election. We don't know who the leadership is, but I think this affords Canada the ability and opportunity to actually get business investments. And it could be an opportunity for Canada to actually to benefit from that because there's been so much focus on the US.
I think there's a big question to what extent central banks come in and ride to the rescue. I think coming into the year, the concern, particularly in the U.S., was the Fed can't cut. Inflation is too high. Now, the market is pricing in 5 interest rate cuts this year. Like, how much does that soften the blow?
It will soften it. I think definitely if you think about what drives the U.S. economy is obviously consumer base. So the consumer obviously is going to be sensitive to that. Recall last time when we talked about cuts, I think the market was anticipating many cuts and it turned out to be either lower or less or longer. So while the market is anticipating 5 cuts, we're always just careful in terms of watching what happens.
That's good perspective. And so there's the central banks that could ride to the rescue. And then there's governments themselves. I mean, just in the last 24 hours, Ontario announcing $11 billion in support for businesses. Quebec is posting, some of the biggest deficits that they have seen, in part because they're trying to support these companies that are going to be addled by the tariffs, regardless of how long that they're in place.
Yeah, and I think there was an announcement earlier that BC is actually going to push some of these projects to quicker, approval. So I think that's all positive. I think there's a real wakening up call for Canada to be less dependent on the U.S., to find other avenues in other markets, and to encourage investment in Canada.
So the takeaway, it seems like, there will be opportunity. We're maybe not there yet.
Yeah,
So don't rush in to buy the dips.
Personally, that's what I'm doing. I'm just waiting. I'm a little cautious. I'm a little careful. And I like watching things settle out before I start buying.
Investing can sometimes be very niche. And I feel like it's a bit of a tell when people in my regular life start talking to me about the markets and start talking to me about trade policy. I don't think I've ever had casual conversations about trade policy. And this weekend, I had like 4 kids' birthday parties. And I had parents coming up to me asking me about trade policy and just like, what is he doing? What is Donald Trump doing? Does this even make sense to bring manufacturing back to the U.S.? You had Howard Lutnick saying, everyone's going to be screwing in iPhones and it's going to be this glorious factory life. Do people want that? Like, is that the end goal?
I think he's campaigned, obviously, on bringing back jobs, very concerned about defense, which is why we're seeing manufacturing coming back. I think marginally we could see that. The question is to what extent, and we don't know yet, depending on how it happens in terms of the tariff policies. I think there's going to be movement of manufacturing back to the U.S., and it's just dependent on the extent. And that's partly dependent on how the tariffs actually shake out.
Okay, let's dip into the mailbag now and talk about some of these stocks. Okay, let's get into the mailbag. Our first question is about Canadian banks. Do you have a favorite in the Canadian banking sector? Are tariffs a concern for the sector? This one coming from Joanna in Hamilton, Ontario. And you're talking recession. This obviously is going to hit the banks. How do you think about that?
So I actually just attended the Royal Bank Investor Day, and I think Royal Bank is quite the premier company. It seems to be ahead in terms of using artificial intelligence in their operations. They've been working on this for a while, so we're actually seeing evidence of this. I don't disagree with the comment. If GDP growth slows down in Canada, there's no doubt banks are going to be impacted by slower loan growth. The other thing we've had in the last couple of years is very benign credit environment, and we've seen that increase. And there was a hope at the beginning of the year that this will level off. We've seen peak. And if this continues, particularly with its tariff problems, I think we could see higher levels of credit provisioning in the banks, which is not good for earnings it lasts a little while. So I don't think we're over that as well. Overall, I mean, the banks, their capital positions are great. Their dividend yields are great. I just think that they may be challenged in terms of earning growth because of credit. And then add on top of that, capital markets. A lot of people are saying, hang on, we're not going to buy things. We're not going to sell things. We're going to let everything settle down before we actually come to the market. So I think we might see a delay in M&A and capital markets activity.
It's so funny you say that because this was supposed to be the year maybe the IPO window was going to crack open and any IPOs being contemplated. I mean, that door must be shut by now.
I think it's being shelved right at the moment.
There was actually a note out this week from a bank analyst. I think it was Gabe Duchesne at National Bank. And he was talking about, again, high quality companies. If you own for 20, 30 years, like they're in a solid position. But investors have to decide, is this a short-term issue? If it's a short-term issue, then you could buy right now. But long-term, if you're comparing to crises like the financial crisis or COVID, there could be some more downside here. And it sounds like maybe you're skewing more towards the latter camp.
If you think about it from an earnings perspective, there's more risk on the downside. So that's my point. And when you have earnings revisions down, it's very hard for stocks to rally. But you make a very good point, Amber. When we talk about stock picks, it's really about your time horizon. And because our time horizon is longer, we're able to weather the dips. But I would say we've got more near-term downside to earnings for banks just because of this credit and lack of capital markets.
Okay, so maybe you put that in the homework pile if you need to dust off your recession playbook that doesn't come to fruition. Let's talk about that as it's expressed through Canadian Tire. Amid concerns over a slowdown in Canada's economy, does Jeannine think Canadian Tire is a buy here? This one coming from Roger in Sault Ste. Marie. This one's got to be like the poster child for a stock that gets hit in a recession.
So I think Canadian Tire is a very well-positioned retailer. If you think about its reach and geography, I think there's a stat where every Canadian lives within X kilometers of a Canadian Tire and the assortment. And it's a unique model. I think a lot of U.S. companies, U.S. people look at it and don't really quite understand. So I think it's quite unique. But to your point, the Canadian consumer is going to feel pinched. And I highly anticipate their discretionary spending to go down, and Canadian Tire is just not immune to that. They also have exposure through their credit card portfolio. And somebody actually just sent me the stats recently, and their losses are actually not that bad. But if you look at their delinquency in terms of payments, it's ticking up. So time will tell whether that will turn into losses, but they don't. It's very similar to the banks. Their credits, they are exposed in terms of credit. They're exposed in terms of potentially a weakening Canadian consumer. And they also import, obviously, a lot of things from overseas, which, depending on the trade flow, could or could not impact their cost of sales.
I saw, if you watch Saturday Night Live, Mike Myers, he was there impersonating Elon Musk as he has been, but his, and of course he's famous for his elbows up now, but the shirt he was wearing was a Canadian Tire shirt. So he kind of brought that brand to the US. There's that movement for Buy Canadian. Is that kind of like more marginal, you think, in terms of like what it could mean to a Canadian retailer like Canadian Tire?
It is marginal, but I think it's positive. And at this point, we'll take anything that's positive. So I myself am doing it. I go in and I don't want to drink American wines. I'm, trying to avoid to much extent as possible and support the Canadian economy.
All right, let's jump to the rails. CN Rail, which I own, and Canadian Pacific, Kansas City. Does Jeannine like the Canadian rail stocks? Is she concerned about the impact of tariffs? This one coming from Arnie in Toronto. I feel like that these are all stocks that, great company brands, long-term history. maybe dented by a potential recession threat.
I would agree with that. So these are great monopolies, irreplaceable assets. You will not be able to actually replace that kind of infrastructure. Great balance sheets, well run. They actually had pricing power even in 2008. So they are able to keep price. But at the end of the day, they are exposed to economic activity. And if GDP slows down, they're going to be impacted. And so I think that's what the worry is in terms of their economic sensitivity and the fact that we could see slowdown. CP also has obviously bought Kansas City, so they have exposure to Mexico, and people are worried in terms of the trade, whether they will suffer from volumes coming out from Mexico back into the US, which I think is an unbelievable network. It's just we have to go through a little bit of a waiting period until we see some economic activity. The other thing I think that could impact near-term earnings is people were worried about the tariffs, and so there was some pull forward in terms of shipments, and it may manifest itself in not this quarter, but the following quarter, volumes coming down just because of the pull forward of volumes. So I'm a little worried about that risk near term. So again, I'm sort of waiting and watching to see how this all shakes out.
So the question becomes like, is that already priced in? CN and CP are down about 25 to 30% from the most recent peak. CN is trading at the lowest level since the pandemic.
Right.
What would you say to a dip buyer who says, this is a great entry point?
So I'd go back to your original comment in terms of time period. If you have a very long time period and you can weather, further downside, just because it's such a macro environment doesn't mean that there's any fundamentals. Just stocks will go down. Correlation goes to 1 in these types of events. But if you're going to ask me for long-term, CP and CN, absolutely. They're phenomenal businesses with infrastructure that can't be replaced.
All right, let's take a quick break here and we'll get to more of the mailbag questions. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit RaymondJames.ca today to discover how you can live a life well planned. All right, let's continue with some of these questions. Our next one is on TELUS. I've held TELUS for years, and it has not moved at all. Why not, considering the lack of competition in Canada? This one coming from a question on Instagram, Windsurfer413. All telcos, to be honest, have done extremely poorly. So it's not just a TELUS problem, but are you looking at this sector at all?
Yes, actually. I think it's actually, we talk about what's been priced in and, how these stocks have performed. There's no doubt there's a fundamental reason why any of these telcos haven't worked. One, the pricing competition in mobile plans have been quite intense and they haven't lessened. And, I occasionally see these executives speak and you hope, 3 months later it lessens. They're not seeing any lessening. So I don't think that's positive because that's been the growth engine for these telco companies. Secondly, you have very specific, idiosyncratic reasons why, not for TELUS, but for BCE and Rogers, and it's impacting sort of the whole sector. BCE is trying to actually close this transaction. Obviously, Rogers with Shaw and this new deal that they actually signed, people are worried in terms of the debt levels and the sustainability of the dividend. We own TELUS, actually. Part of it is, I think a lot of it's been priced in. We think it's a company that's going to survive in the long term. The dividend yield is quite attractive. And it's also a balance in the portfolio in terms, when you build a portfolio, you don't want to be tilted all in one way. You want to be more balanced. And surprisingly, the telcos in this whole chaos that we've had have actually outperformed the rest of the market. So we like having that balance in the portfolio.
So when you say you like it for the long term, 8% dividend yield is still really high. It's not as high as BCE's, which many are calling unsustainable. But do you think that 8% is sustainable for TELUS and they're not maybe in the same debt concern issues as the others?
I think 8% is a function of where the stock price is, right?
Yeah, that's true. And the dividend yield is a function.
Yeah, as opposed to the cash flow. I think BCE is more challenged on the cash flow, which is why the dividend yield is so high.
Do you think BCE is going to cut?
I would say that the consensus opinion is probably going to cut.
Okay, well, we'll go with consensus then. Capital Power is another one that we have a question on. Capital Power has had an incredible run up, then had an equity raise, then straight down. What do you do with the stock? With this one also coming from a question on Instagram.
So Capital Power obviously is an electricity producer, and I like it because it's, electricity. Everyone's going to need electricity, and there's obviously going to be a demand for electricity. I think it got carried away with the AI trade in terms of people getting excited about the possibility of new generation that they could put in because of the demand for AI. And as always, as you've seen, Amber, when things get crazy, it always gets overdone. And I think it got overdone at some point with people getting excited and got overpriced. And so I would say it suffered lately because all those people that came in and played it and pushed the valuation and the multiple up have come off as we've seen a slowdown in this AI. And now there's a question with these policy changes and so on, how fast can some of these data centers actually be built? But if you look at Capital Power itself, how much is, they have long-term contracts, their position in terms of geography, both in the US and Canada. And it's likely that we're going to see AI, the need for power generation in the US be bigger than the Canada, obviously. They will benefit. But it's no doubt that they've suffered. So
Alberta has actually been doing a lot to attract companies that are looking for AI capabilities and AI power to Alberta, and Capital Power has big exposure there. When you say it kind of got carried away, I felt like some of the companies, maybe even in the US, they didn't even have AI-related deals, and they were increasing. So it was hard to see how much of this is actual AI versus the hope AI is going to show up. How did that apply to Capital Power? So I would put TransAlta and Capital Power in there, and obviously TransAlta has more Alberta. I think the hype got in before. There's also an application where you can apply to be connected to the grid in Alberta. And I think it went to 9 gigawatts or something. And the reality is it's a very small percentage will probably be connected, but people were starting to price in these things. I don't doubt that there's going to be additional power. I just don't think it's going to be as big as what people thought it was going to be when the stock prices were very, very high. But now, I mean, now that the stock's pulled back, now that the stock's pulled back, I think they look attractive. Yeah. Okay, let's end with this question. This was on TFI International. This stock imploded recently and is down, trading at the lowest level since 2022. What are your thoughts on the stock? Trucking and logistics. So they reported Q4 and it was a huge miss, and they brought down guidance, which is why the stock fell. And most of that was on their LTL US. That's less than truckload. Less than truckload US, yes. And that is very economically sensitive, particularly to consumer spending. And so it got hit. And it's not alone. All the US truckers, all the logistics, have been hit. And they had to bring down guidance. So I think it suffers from being economically sensitive. The U.S. is a little bit more volatile, I would say, than the Canadian operations. Canadian operations, LTL, is actually very well run. The operating ratio in Canada, they've always guided that they could bring the U.S. up to the same kind of, higher levels. And I think that's just going to be challenging in this environment. So this company also said they were going to re-domicile to the U.S., which is not the vibe right now, right? Yes. We're all buy Canadian, and they had to reverse that decision. And I wonder, with your investor hat, I know you have a patriotic hat, but with your investor hat, is it the right thing for a company like this to re-domicile in the U.S.? I have to imagine that the reason they reversed it was just on patriotic and backlash grounds, but that there maybe was a business case to re-domicile in the U.S.
From a financial perspective, and I can't remember offhand, there might be a taxation advantage because the U.S. taxes are lower. But from running an operation, they would still keep their Canadian operations. Now, they've talked in the past of splitting the company, which I think has been also another attractive point. But at this point in the cycle, I find it very unlikely that they would contemplate that, given the fact that we're sort of in an economic low.
Okay, so not successful in finding a lot of stocks you would buy right now.
Right.
But that's why we have Pro Picks, because we're going to find out what Jeannine LiChong does like. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, your first Pro Pick is Dollarama. What a darling Dollarama has been. Its quarterly results, I think on a day when the market was selling off, Dollarama still hit an all-time high. So it's still growing, and Canadians are pinching pennies, pinching dollars, and it benefits Dollarama.
Right. So I've followed this company for a very long time. Actually invested it when it went public in its IPO. And what I like about this company is that it's very cash generative. And it's self-financing. It was self-financing when it was just only in Canada. And there were a lot of levers that they could pull when they went public in terms of expense saves and bringing IT systems and labor savings. And they've done all that. Their margins are unbelievable. I think their EBITDA margins are 3 times Canadian Tire company that we talked about earlier. And now they've announced that they are expanding sort of in South America, and they recently bought something in Australia. And Mexico, they're just starting to get started. And that's all self-financing. They're actually not only self-financing, they're actually to be able to pull dividends from the South American up to the parent company.
So this is an important point. They're not levering up with debt.
Absolutely not, no.
And so they're expanding into markets that are going to immediately add to their bottom line.
Correct. I mean, Mexico will take a little bit of time, but that's not unusual for a new geography. So I think they're excellent merchandisers. They know how to buy. They know how to package, and like they're cash flow generative, and they also appeal to the consumer in this kind of environment.
Because they're not in the U.S., do they get hit by tariffs at all?
They get hit by tariffs. No, because they import from Canada from China, so they would not be impacted by that.
So this is like one of those unicorns when you're saying we're trying to find non-recession, tariff impacted stocks. Like Dollarama really stands out.
Yeah.
So you've owned this for a long time, or you've owned it, since the IPO. Like, is that a steady hold, or are there times to own Dollarama and times to rotate out, or is it just a constant?
To me, it would be a core holding in a portfolio.
Okay, let's go to your second one, Intact Financial, car insurance, property insurance. Why do you like this one?
I've owned this one actually for a long time and have followed it once it's gone public too. And this one, I would say, would go through periods of, times to have a bigger position and times to have a lower position, depending on where we are in the insurance cycle. But I think also of it as a core position. And right now, we are in an environment where insurance rates are still pretty strong. And, talk to your birthday party people. Are they complaining about their car insurance and their house insurance and business, which tells you that there's still pricing power in the environment. So I like that because they have good visibility in terms of pricing. And if there's a change in the environment, their duration of the liabilities is only a year, so they can reprice. It's unlike a life insurance company, which duration is much longer. So I like the fact that they can reprice annually. Secondly, they've been a great job in terms of controlling costs, vertically integrating, getting partnerships with auto dealerships. So I like that, their cost discipline. And then they've been very successful at acquiring different companies. And in particular, they bought U.S. Specialty in the U.S., which is a very niche, has better chances of holding price because it's a niche market. And in the UK, they've also bought some operations. So I think, They're well operated. It's a good hard market, good control costs, core holding.
And it's outperformed. It's outperformed over the last year. And when the market has been selling off, Intact has held up. I guess the question is, can those gains continue?
It is considered a defensive financial. So if people are less likely or more concerned about the banks because of credit, I think it would be a financial that people would want to own.
Let's talk about your third one. Another one that's done remarkably well is just a couple percent away from an all-time high. That's Loblaw. Talk about why it's the right stock for this environment.
So Loblaw, out of all the grocery stocks that are publicly traded, have the most exposure to discount. No frills. And no frills in the last couple of years, if you listen to the conference calls, the conventional shop or the conventional stores has been losing share to the discount. And they've been able to maintain their market share and gain probably because of their exposure there. So I like that. Secondly, they're well capitalized. They've been buying back stock. They've actually also benefited from food inflation. They've done a fairly good job at controlling costs, although labor has been a bit of a problem for them. So I do like Loblaws. I think it is a staple. And I think they will benefit because even in a tough environment, people will go to the grocery store.
Is it too expensive? Like the stock, its current PE is 30 times, which sounds high.
It is. And I would say Dollarama is not cheap either. I think you pay for quality of management teams. You also pay for, their financial discipline. And both of those companies are buying back stock quite heavily right now. So, we own both. Yeah.
But Dollarama has margins, right? And they're doing really well because from $1 to $5, they've been actually steadily increasing their prices. That's been a big part of the Dollarama story. Not increasing prices, but selling more goods at more than $1. Loblaw grocery, those razor-thin margins. I often wonder why food inflation coming down isn't a bigger problem for Loblaw. Is it because they're able to offset it through volume at no frills?
They are. I caution sometimes they will say themselves, food inflation is good, but to a certain point, because at a certain point, the consumer is not going to buy. So then they will suffer from volume coming down. But right now where inflation is, they're benefiting.
And they've been just going into the stores. It's the next day they had Buy Canadian stickers on everything.
Yeah.
They have now the little T symbol if it's affected by tariffs. So that's a very quick turnaround at all of their stores to really quickly communicate with their customers.
Yeah, I'd say their marketing is pretty good.
All right, Jeannine, I've had a blast. Thank you so much for joining me this episode.
Thanks for having me, Amber.
That's Jeannine LiChong joining me from Waratah. Make sure you stay tuned to our next episode. We've got Darcy Morris on the show. He's a Canadian fund manager with Ewing Morris, and he traffics in small and mid caps. But he is a pretty loud voice in the boardrooms. He's been on a number of activist campaigns. He's got some more stories to share with us, as well as some of his top ideas as usual. If you've got any questions, you can email us questions@inthemoneypod.com. You can find us anywhere on social media @inthemoneypod, and we'll catch you on the next episode.